Thanks to Gaurav. The stage is yours now.
Great. Thank you, Shivam, for this. First, I would just like to, thank everyone for joining. It's always great to get the founder energy, and it's always so inspiring to be in a room of such aspirational founders wanting to build. So that's one of the primary reasons also of me, being in the venture capital space because you get to talk to founders building every day. That's the great journey that you foresee. So yeah. So since everyone gave a quick background and introduction of themselves, I will do the same. Uh, and maybe quickly give a background on the fund that I work with as well. So, you know, I started off in corporate finance in a listed auto ancillary firm in the CFO's office, working on everything finance from manufacturing, got my hands dirty in cost accounting, mergers and acquisition, strategy, everything basically that the finance job entailed in the CFO's office. I got to do that. Soon I realized that I want to, look at startups and deep dive much more in this world of new startups coming in. That was the first phase of the Walmart had just bought out Flipkart. That was the biggest first exit in India, and I was seeing myself, look at these new business models, startups getting funded. Soon I realized and got into Roots. That's the current fund that I work for. It's been 6 years for me at this fund. Uh, and I've seen the whole journey of deploying capital to uh, first fundraising, deploying capital, and now exits. And soon after we launched our second fund, is where we are currently deploying from. Second fund is a larger fund, and we typically, although here I got an understanding that most of you would be in the ideation, MVP, PMF stage, pre-revenue. We, as a fund, typically come in at a pre-Series A, Series A stage, where there's some revenue traction that we'd like to see in the companies that we have invested in, but primarily sector agnostic. So I keep at looking at, and since the lean team, I get to get my hands dirty in different sectors altogether, and that's how our fund portfolio also has turned out to be. We've done about 25 investments so far and two exits done. So some known companies that you guys would know would be Jimmy's Cocktail, Daily Objects, JAR being in the financial saving space, Stock Grow, Smitten, and quite a few tech companies in the seed stage as well. But typical sweet spot is doing a 5 to 10 crore check size for a 8 to 12% stake that we come in. So yeah, that was more on the fund. Now, just to for this session, there's no presentation, but I was making notes of what I had in mind to share because I understood that since most of you would be in a very early journey of starting up and understanding the business and staying true to the topic of what do investors look at when they are coming in wanting to invest. So I would keep that specifically to as a seed stage investor because every stage that the startup will grow, there'll be different parameters, key metrics that they would look at. But for right now, for everyone's benefit here, I would stick to the seed stage or pre-revenue stage where most of you guys would be in. So correct me if I'm wrong. If I can take that stance, then I can go ahead.
Yes, Gaurav.
Yeah.
Please.
Definitely, sir. We are mainly looking for seed funding. What the main exact expectations of investors. So really, thanks for that. Thanks for guiding the meeting.
Right. Great. And, we can keep a very engaging discussion as well. I don't mind being interrupted and when I'm speaking. So, especially when there's a question, you can shoot and we can probably digress as well when I'm speaking, but I'll still cover the points that I have in mind, and then we can probably do the Q&A. So, starting off, seed stage, when the company doesn't have primarily revenue to show. Uh, these are primarily angel investors that your key target people would be to look at in terms of fundraising. Angel investors would typically be friends and family round. Usually, what is what happens, or it could be HNIs that are single-handedly just investing. Uh, Primarily based on just when the company is getting launched. Or these are accelerators or venture studios like first 500 days as well, where these are typically at seed stage is where they are coming in. And primarily the first thing, one of the most important is the whole they are betting on the founder. They are betting on the person that is behind the startup. So there are quite a few deals that I see fall off because of the match between the founder and the investor as well. So it's a lot of luck. It's a lot of right people that you are in touch with, and that whole connect with the investor needs to be there, because that is one intangible aspect that is taken care of when the investor is believing in you. So when I say founder, it is founder background, their ability to share their story, and story is from the beginning, from the roots of where they have started, why they are starting this business, what's behind their mind of why they want to build that business, because the investor is also looking at, after 5 7 years, will he able to give me an exit? Is he looking at IPO? Is he looking at just making money short term and exiting the business, and the reins will go to someone else? All those softer aspects which can't be calculated. It is primarily the investor's judgment that they are getting in on the intangible factor of getting to know the founder and believing that if he is the right person to be able to build that business. So that is one factor. Then in a sort of a deck perspective also, for seed stage companies, decks are really short. So it typically comes down to directly storytelling, that objective of what is actually the problem you're solving and how are you solving it. So that problem and solution slide that we see in the deck is almost as critical as like I mentioned, the founder background and their journey, all of it. So being in detail and be very crisp of why you are solving, what are you solving, and how are you solving it. So because in seed stage, like I said, there are only these uh, clarity of thought and softer aspects that you can bet on, because on paper you have nothing to show, even probably when it's and some HNI, some angels might not even look at all of this, but some investors who are actually trusting you with the money early stage, and if they are especially institutional investors, institutional but seed stage investors or pre-seed, they are still backing at because they are in their mind creating that investment thesis of why they are backing. So they need those factors of you know uh, factors when they don't have a product or a service live, which is not yet launched, but based on the money that is given to the startup and the founder, is where they will be able to have confidence in building that conviction to invest. So that is on the problem and solution. Then comes early on, how is if the founder has been able to it comes to the team. If the founder has been able to build conviction to other team members, other good talent that they are able to attract, and they see potential in the startup to be able to grow. Maybe there's some hiring of a co-founder, there's hiring of below level management team that they are able to get on board, and that shows a strong conviction that wow, they've built a strong team and they'll be able to do it together. Because founder is just being the solo founder is a very lonely journey, and of course the more the merrier, and a bigger team built at an early stage gives all the more conviction to the investor that this team will do well and they'll be able to succeed.
Gaurav,
We miss Gaurav.
Gaurav,
Yeah.
you're on mute.
I just realized I got mute. So yeah, then coming to some invest coming to the market size, right? There are investors you will see of different sector thesis also. There will be some investors that won't entertain at all if they are, especially if they are, of different stages, like a private equity or a pre-series A, series A won't even look at a pre-seed company, right? But even if there are accelerators or venture funds primarily looking at the stage that you are coming in, there might be some that there are sectors that they would have a negative list on, and that is their personal biases and funds, theses that they would not look at specific sectors. So, for an example, when there was the edtech funding boom in 2020-21, we were strictly away from edtech, and there were quite a few startups that came our way, but it was just the bias that we had, thesis that we had created, that this is a sector which is very hot and valuations are running. It is not sustainable. We don't want to, stay and be in this and invest in any companies and waste our time looking at companies in this sector. So even at that early stage, there will be company investors that would not be open to even looking at companies if you belong in that sector. And it'll be so you'll have to do that homework investor wise, because every investor, every fund would be very different. If there is already an existing portfolio company of theirs that has invested in a company that it might be your competitor, again, that would be a double portfolio. Although there are very few funds that do invest in companies that are in the similar space as their portfolio, but most of them would stay away. And the
Gaurav, Gaurav,
yeah.
can you just come on to that last point where you are mentioning about co-founders? You were what I understood is like you were saying co-founders must be there from the background which they having experience with, right? Or
No, not necessarily. Of course, there is, uh, you know, uh, what do you say, hiring that can be done, and but between the founder or the co-founder that has been onboarded, they should be able to convince why are they the right people to build in that particular sector. So 9,009 times out of 10, we see that problem, or that uh, why that founder is actually trying to solve that particular problem, because they've been in that sector and they've seen the in and how of how that sector works and the inefficiencies and whatever problem that they're trying to solve, they already have the background. There's very few or very rare startups founders that we see that they're building something from scratch, where they have very limited knowledge, or just because they are excited about one particular they try to deep dive and get it. So typically, usually we see there is some background of the founders that whenever they're trying to build in a particular sector, they have some knowledge or background of it.
Mhm. Okay, okay.
Yeah. So yeah, I was on the market size, right? So in the market size aspect, there will be the funds or investors that who will do their own analysis. Although you would have, in your deck presentation, you would have created a top-down, bottom-down approach of how to analyze of whatever big market opportunity that they have. They will definitely do their own homework of, how they analyze whether it's a big market, as how the founder is presenting it to be. So they will again have their bias here, whether this market is worth going into, and it will have nothing to do with the founders problem they're building. This will again be another key factor, uh, because they are responsible for their LPs, the limited partners. They are the mediators, right? We are deploying capital, but that capital is not ours. We are the mediators getting money from investors. So we are also answerable to our investors when we are deploying capital in our portfolio, in our evaluating companies, portfolio companies. So uh, if it makes sense for us that we are not able to gauge if the market is big enough, if the company will can be huge enough to return that capital to us, there'll be funds that will again be staying away from such a sector. So sector bias again kicks in terms of the market size of that particular company that they would be evaluating. Then very clear. So next is on the business model. So how you're going to make money, because obviously you've not started to make to have the MVP, or since it's a pre-seed company, you are wanting to set shop of for a product or a service, but being very clear on how the business model is going to be, how is it going to be, if it's a software, paper, use, if the product, what the pricing is going to be, that market analysis of where your product fits in, if there are other players in the mass premium segment. So that whole clarity of where your product or service fits in the current market, I think that again builds the right perspective for the founder to further analyze where they would be in terms of investing. So that is on the business model. And second is uh, go to market strategy. Externally, as a fund, we keep saying that when a product or service is built, it's almost hygiene, but distribution is key. So anybody can now build a product or a service, and there might be different USPs of the product which what you are offering is very different from the others. But if you're not able to sell it, you're not able to make money, and your company won't grow. So that salesperson attitude of being able to create a distribution where your product or service gets a platform to be sold is another very important factor that VCs evaluate. As that product is built, it's amazing, we have great feedback on it, service is amazing, but are they going to the right people? Are they able to touch the right set of people to be able to build a revenue stream for that product or service is the key factor. And yeah, that's the go-to-market strategy. Then comes in the projections. Projections again ties up to the same thing that I was talking about of building a revenue stream uh, based on the distribution or the revenue channels that have been chosen. Uh, Maybe showing the investor of a forecast of how the revenue and probably the bottom line numbers will look like in the span of 1 to 3 years maximum, or once the product is built. It's almost showing like a roadmap that this is when my product will be launched. This is when I see my first pilot to be going on. This is when revenue channels will start kicking in, and money will hit the bank. Uh, and so that shows a foresight to an investor that this is the journey that they are looking at, and they will definitely have many more questions for you once you have built that up. And last is on the fundraise and the allocation. So how much are you looking to raise? What exactly is that money going to be used for? And that again ties up with the projections of this is the revenue you will be able to build based on how much you'll be able to raise. This will go in the product or service. It'll go for employing, hiring, uh, or marketing. So, and then showing in the next stage of fundraise that this is 12 months from this period is when you again start to look for a series A, series B round. So showing that whole journey, kicking in with the roadmap is what the investor expects. So these are broad you know headlines that would basically just chart out for an investor uh, as to broad level. The first meeting when you get to have that with the investor, this is the basic roadmap that they would want to see. Anything above that, beyond this, is going in depth once they have shown that early interest based on this. Because after this, there'll be much more deep dive. Maybe if it's a tech product, they'll want to see a demo, uh, get on to, then they'll do their feedback of getting understanding from the market of how the peers is. Of course, here I missed on the when I was talking about the market. There's the peers angle also, where you're in your market, you're also showing your other peers of the list. If you're trying to disrupt incumbents that are already there, or it's a completely different new service trying to enter into a different market like a trailblazer. So all of that. Yes, happy to take questions now. I'll monologue.
Guys, anyone have any questions? Please feel free to ask.
Yeah, Gaurav. Shivam, if I can just start with the question round, if that's okay. Yeah, great. Gaurav,
Yes,
great.
yes.
Yeah, thank you so much. Yeah, thanks for enlightening us. It's been great discussion. I think these questions are with every founder, especially today's date regarding fundraising. There's so many things happening in the market. I myself have worked with early stage. I work with Series A companies. I've worked with pre-seed companies. Just for a little clarity, I think for everyone, probably for myself also, I have a couple of questions, so I'll go one by one. Just allow me, please. Huh? Couple of questions. Could you just give a brief differentiation between the different rounds? Starting from, since most of us are in the early stage or ideation stage. So, what exactly and how would you define a pre-seed or a seed or early stage versus a Series A? Because I think that's a big confusion all of new founders have. Which stage am I at, and what kind of funding am I looking at? Yeah.
Sure. No, that's a great question because these terminologies are so like with because the sector is so unorganized, right? Where every if a founder is able to raise a large seed round, it becomes a Series A. So typically, a pre-seed round is when you don't have any product, or your company also might not be registered, and it's typically a friends and family round. So that's typical, and that check can be anything between 100 whatever amount. I'm not putting a minimum amount, but could be up to 500K, 700K. It goes up to that. I've seen different companies. So these are just basic terminologies used, but I've seen different companies use different variables to define that. But that's the pre-seed seed round. Then Series A, pre-Series A is when you've launched your company, you've started the revenue in terms of your PMF is done, your MVP is launched, and you're starting to see traction. And that's when your pre-series A, series A, again a loose term, but can be uh, so pre-series A can be the bridge round to series A, can be a smaller round, but all of this is done where your MVP, and your PMF is already done. You've started getting traction, and now you need money to, uh, your base is set. Now you need money for marketing, growth, hiring. So that's when your pre-series A, series A comes in, which would be anywhere between a million to, again, 5 to 10 million. Also, I've seen rounds up to 10 million Series A rounds. And obviously, there are such exceptions to the rule, like Cred, that have beyond 50 million seed and Series A rounds. So these are exceptions more, so not the rule. And then just uh, the funding round increases, and the Series A, Series B just goes on from there. So Series B would be anywhere between 10 to 30 million. Series C would be anything beyond 50 10 to 50 million, 50 plus beyond. So these are just figures and bases that would set in. And the reason they are called A, B, C, D different are that these are not small bridge rounds that are leading to that, but these are milestones of the company where they have achieved that particular growth and would have lost the runway, and they need that further capital because there's conviction of building a bigger business than where they are. So yeah, these are much larger rounds, newer investors or existing investors doubling down, coming in with the different stages.
Excellent. Yeah, my last company had a series over 25 mil, so that was really big round.
Yeah.
Just a couple of really quick questions. I'll just run them through you. Once you come at a state of when you have a go-to-market ready, you have a MVP, you've done your product market fit. Okay. Now, from an investor or VC point of view, right? What do you give more importance to? Are you looking at traction in terms of user downloads, user acceptance, or are you looking at monetization, which can be done at a future stage also, right? If you're a D2C kind of brand, you're looking at monetization from day one, right? You're looking at how many people are purchasing orders, repeats, and all. Let's say you're a service, right? You're coming from a service background, where your, the engagement might not be, on a daily basis right now, but people are accepting the app or the product or the service and want to keep it for future use because they know, okay, fine, they might use it on the later stage. So that gives me a higher traction, but might not give me a higher DUA or a MUA of sorts, right? But I know that there is a scope of future monetization, as in once I have people on board, I can then slowly start monetizing my service or my platform. So what is given more importance from your point of view?
So you already answered the D2C brand aspect, right? Where
Yeah,
monetization will be key since inception. And
right,
for a service kind of, startup, I would have two answers because there would be two different types of companies that I would be looking at. So I'll just give examples. If it
right,
is uh, a network effects kind of a service where it augments once there are many more users that come on board, I would look at it differently. But if it is
right,
primarily, just a service, like an example could be an urban company, right? I would
right,
still look at monetization because uh, if the DAUs and MAUs are also not uh, as active, or uh, it's very tough for the user to be monetized much later in the stage because you're building a habit very early on. So
right.
it can vary from company to company, but how I
Okay.
we have looked at companies at our stage and even our portfolio companies that have struggled in the service space to monetize later. What they would
Hmm.
have also realized is that coming in at uh, that early stage of monetization also, where whether they'll be wanting to be able to pay for that kind of service. I think early on
Right,
some monetization, even if it's a freemium kind of model, we would
right,
like to see that. But if there is a unique company where the hook for the consumer is a different kind of product, and then later on they are coming in with a different, completely different, unique uh, solution where the user is then monetized, that's a complete different story. And what I'm saying
all
right
right,
now is the example of Cred, because when Cred
okay,
users came in on board, they came in to put in their credit cards and to pay it quickly. Now those users years later have been monetized into
right,
loans, e-commerce, so
correct.
much more
Yeah, yeah,
that they have to offer. So
yeah.
those
Multiple
habits
revenue
have
streams
been
are now
built.
coming. Yeah.
Yes. So
Okay.
unless it's that kind of a unique, then the habit building to change that is easier. But if
Mhm.
that's going to stay the same, then it's better to monetize them early on.
Okay, excellent. Sounds good. One last question. I think it's out of syllabus, but there's been a lot of debate on LinkedIn and all across as I'm reading. What are your thoughts on bootstrapping versus funding in terms of VC or bootstrapping?
A very controversial answer, but I'm going to do that anyway, especially for the field
Right,
I am in. If it was to me, had to be me, I would rather be a bootstrap company than be in the
right, right,
because of one, and actually I also had made a post about this. The reason being that I would, this is a personal choice, right?
sure,
I
yeah, yeah,
won't be answerable because being on the other side, I won't be answerable to an investor, to anybody else. The reason I'm
mhm,
choosing to be a founder is also to, have my own startup and choose the way I want to build a company. And that
right,
not having a VC on board or an investor on board and just being completely bootstrapped will
mhm,
be at the cost of growth because with VC money I can grow easily. So here
right,
I'll be
right,
compromising on growth, but I will not be compromising on being liable or being able to return the money to for someone who's given me that. And I don't want because there are so many clauses also that when an investor comes on board,
right,
I want to run my business a certain way with my team and be profitable and not chase growth. So that's where my answer lies
okay,
in. There are two, of course, two schools of thought, right? The Zerodha, Zohos of the world,
correct, correct, yeah,
which are
yeah,
completely bootstrapped, wanting to stay that way. And then there are the Grows of the world, where they are, you know, we've seen the trajectory. So yeah,
great,
that'll be my answer.
great. Great. Thanks, Gaurav. Thank you so much. Yeah, thanks. It's been a pleasure. And sorry, guys, for taking up too much time. Yeah. Thanks, Gaurav. Thank you.
No, Aditya.
Thanks.
Guys, another question from anyone? Seems Arjun
Hi,
got
Gaurav.
yes,
Yeah.
sir. Yes.
Hi.
Gaurav, so I just have one question regarding angel round. So let's say if you are raising, or we are raising an angel round. So at that time, do we really set the valuation in terms of any number, or because again, angel is something friends and family round. So do we really set the evaluation? And if we are setting the valuation, does it really something that VCs consider or not?
So because there are angel rounds, it's the base, set of I think between 3 to 15 CR is where I have seen as the base standard valuation set for angel rounds because anyway they are very small rounds and not anyway before an institutional investor coming in, you can't dilute the founders that are there in the company unless someone's giving a large check, then that valuation can be set appropriately. But for smaller checks, I'm assuming angel rounds being 1 to 2 CR would be at that set of valuation between 5 to 15.
Okay. Yeah. Thank you.
Okay. Guys, another question from anyone?
Yeah, just one question, Gaurav. So, in your opinion, how does one validate their startup idea? Like in your experience?
Uh, Validate their startup idea. Okay, this is during the ideation phase,
Yeah,
right? Best is to speak to your potential customer who's going to end up paying you for the product or service that you plan to launch, right? More than the investor, more than your peers. I think your customer is your answer to because you're building it for them. They are the ones who are going to pay you for that. So talking to as many potential customers as you can, and if checking if they are willing to pay that particular price for the problem that you're solving for them, I think is the best validation to get something.
got it. Thanks a lot.
Okay. Guys, another question from anyone?
Hi Gaurav, Ashish here.
Hi.
Gaurav, I have a very specific question because I'm looking for some pre-seed fundings. So, what should be a strategy for like non-IIT IIM guy? And since my startup is is a developing field right now, Because just now, I guess Urban Club just launched something in this field, and maybe there are two or three more who are actively working in this one. So, what should be my strategy, and what kind of money should I be looking at raising right now?
Sorry, strategy for fundraising.
Yeah.
Understood. So, as much as we say, there are still stats that discourage even investors like us, that there are 70 to 80% unicorns or major startups being funding giving to IIT IIMs only. So that is something that even we are aware of, and that is an investor bias that kicks in. But for angel rounds, there are quite a few angel networks, and because you are at the pre-seed stage, that's the typical round that you would be looking at to raise itself. So again, going to accelerators, venture studios, there are HNIs you can connect on LinkedIn. There are specific angel platforms like IPV, 100x, that specifically nurture and help the pre-seed companies. So those are the typical, and now even that's has been standardized in terms of like the YC model of seed companies that come in. So those are your best funds to look at.
Okay. Thanks a lot.
Okay, guys, I think the session is going very interesting. Anyone have any other question for Gaurav? Perfect. So I think we are done with all the questions. So guys, I think we can wrap up this session. So Gaurav, first of all, thanks for taking this session. I hope everyone learned a lot from you, and I also hope everyone enjoyed this session.